Good afternoon, ladies and gentlemen. My name is Donna Oosthuyse. I'm the Director of Capital Markets and Group Strategy at the JSE. It's a great pleasure to be here with you today, and it's a great pleasure to be here with such an esteemed panel to talk to this topic. I'd like to introduce immediately to my left Mr. Bertrand Badrake, who's Managing Director and CFO of the World Bank Group. And I think, as you all recognize, the World Bank Group for decades has been a leader in infrastructure finance and continues to play a very important role across Africa in what is happening in infrastructure. To his left is Bob Diamond. Bob is the CEO and founder of Atlas Merchant Capital. Bob is certainly no stranger to Africa and for many years has been a champion of the investment opportunities across the continent. Next to Bob is Ido Amenenvue, who is the Chief Executive and Director General of the BRVM. I'm sorry if I didn't pronounce that quite right. I'm better at Portuguese than I am at French. But I will say that for those of you that don't know of the BRVM, it's a regional exchange, and it handles the integrated capital markets of 8 countries in West Africa, and it's a very good example of what could be a model for the rest of the countries in Africa in terms of integration. And to his immediate left is Mr. Pedro Pita Grosch. Mr. Grosch is the president of a relatively new exchange in Angola called Bodiva, and he will talk to us about what could be one of the biggest opportunities on the African continent, which is the development of the Angolan economy and capital markets. So I know that the theme of this conference has been to a great degree around infrastructure. I'm sure you've been bombarded with quite a lot of data and details about the size of what the challenge is. Our panel would like to approach this in terms of what the opportunity is. And indeed, the title of the panel is the Leaders' Dialogue on Secondary Market and Alternative Infrastructure Investment Opportunities. So obviously, when you talk about secondary market, that leads to the question that there has to be a primary market, or there has to be some role of public markets in the debate around infrastructure finance, and we'll have a look at that. But the infrastructure needs in sub-Saharan Africa alone are estimated to be about $93 billion per annum for the next 10 years. And I guess one could say the challenge is that only half of that is being raised, leaving a gap of about $50 billion per year. But I believe that on the positive side of that we have seen overall financing for infrastructure in sub-Saharan Africa triple between the years 2004 and 2012. And the biggest growth has been private sector investment in infrastructure projects across the sub-Saharan African region. So I think that, as I said, you can look at this both as a challenge and you can look at it as an opportunity. I think we in public markets, and perhaps some of my colleagues on the panel as investors, see this as a very interesting opportunity. In the past, infrastructure finance in sub-Saharan Africa was dominated both by official development assistance from organizations like the World Bank, from organizations such as donor funds and aid agencies, and then complemented by traditional bank lending. But there are challenges with both. And what we want to talk about today are what are some of the activities being undertaken by public markets, such as exchanges across the region, and what sort of innovative financing opportunities can we be thinking about to mobilize more funds for infrastructure finance in sub-Saharan Africa. I've been asked to share a few thoughts on what the JSE is doing. I'm actually much more interested in hearing what Bob has to say, but I will just spend 1 minute picking up on what Bertrand has said about the importance of collaboration, and from what Ido and Pedro said about the role of public markets. And just to say that at the JSE we're very focused on the role of infrastructure and having the exchange play a big, important part in mobilizing infrastructure finance. As Bertrand was saying, in terms of the balance of assets between banks and non-banks, South Africa is actually very interesting. We have 8.5 trillion rand in assets in non-bank financial institutions versus 5 trillion in the banks. So it's almost twice the size. But let me just very briefly say, and I could talk on this 40 hours and not 40 minutes, but what the JSE is doing is focusing on two sides. What first is around our listing requirements. what can we do to make them attractive to entities that are sponsoring projects that need to raise capital. And we've done a couple of things. One is that we have loosened our listing requirements to allow for certain types of vehicles, like special purpose acquisition companies and yieldcos. Those are particularly attractive to the renewable energy companies, and renewable energy probably has been one of the biggest successes in South Africa, using this model of collaboration between public and private sector to raise capital. In a special purpose acquisition company, in effect, the entity can list, it can just raise capital and make acquisitions, and it's got a period of time to do that. But a lot of the infrastructure projects are looking, in fact, to take the existing projects they've invested in, capitalize the SPAC with those projects, and then raise capital to go and do more, particularly around the rest of the continent. Very interesting model. And the other is a yieldco, where the issuers basically the equity investors take their investment, put it in a special purpose vehicle, and then take the offtake coming from, in this case, Eskom, and turn it in the form of dividends, and they turn the dividends that the special purpose vehicle would declare, they turn that into a fixed interest coupon payment. So in effect, you get a bond that's based on the offtake of an equity investment. And those are very popular in other parts of the world, and we have mechanisms to list those on the JSE as well. So one thing is to look at listing requirements. The other thing is, as Bertrand was saying, when you look at investing in infrastructure, as a buy-side investor, you start looking at a whole panoply of risks that you never had to consider before. It's not just market risk on the share price. It's not just liquidity of that share. You're looking at construction risk. You're looking at long-term foreign currency risk. You're looking at offtake risk. You're looking at documentation risk. So how do we collectively, the World Bank, the exchanges, regulators, make these attractive? And one of the things that we've been talking about with government in South Africa, and also with the private sector, is can you make this into a special asset class, where you have particular standardized documentation, where you have standardized listing requirements, where the buy side would know, if I buy this instrument that's been listed in this asset class, I can count on certain minimum criteria being fulfilled. It's an idea, it's something that we're looking at. And the other thing that we're doing is looking at providing long-term hedging contracts. We will be announcing in the next couple of months an interest rate swap future contract that will go out 10 years. Under our agreement with IRIS, we can also do currency futures, or cross-currency swaps, I should say, and also credit default swaps. But let me stop, because I really want to hear what Bob has to say. Are there any other questions from the floor? I'm just going to I know we're going to wrap up because we're running late, but I'm going to, before we close and thank the panel, I'm going to do a rapid fire. The G20 is meeting this week, and parallel to that, the B20 is meeting, which is a business delegation that shadows the G20. And one of the topics is infrastructure finance. So 3 recommendations that you all would give the policymakers. Pedro, I'm going to start with you, please.
Thank you. Thank you. Well, I would recommend, first of all, and that's not particular for law, more efficient legal court systems. Also, more flexible regimes for capital flows from foreign investors, non-resident investors, and also I would consider the better mechanisms of financial reporting of the companies in order to attract foreign investment, because we know that domestic funds are not available to fund the project.
Peter, thank you.
First recommendation, I think that it's important to engage our government and regulators to be flexible in the regulation of mobilizing long-term resources. It is very, very important, because if we don't do that, we cannot have large and important resources coming from the domestic investors. The second one is to encourage the innovation in the capital market by adopting international standards and by also learning about what have been done in other regions in the world to enhance our implementation and also to give to our capital market opportunity to be more dynamic, more liquid, and more deep. And the third one is to encourage the insurance companies, pension funds to invest directly or indirectly in infrastructure projects by using, for example, the capital market. Thank you.
Bob?
Two things. First would be to read the Financial Times op-ed this morning, written by Mark Carney and the gentleman on my right, which is about the disappearance of liquidity. And if ever there was an advertisement for deep, rich capital markets, that's it. If we don't have liquidity in everyday corporate and government bonds, we're not going to have liquidity in investing in project finance. And the second recommendation would be first principles. Keep it simple. The single most important thing to develop a capital market is to develop a government curve. And we want to encourage the central banks, and there's been a number of great meetings with the central bank governor of Rwanda just recently and Nigeria, recognizing the importance that we need 3-month T-bills, but we need 10-year bonds as well in domestic markets, both in dollars but also in local currencies, and only then will the corporate market bonds develop.
Agreed. Bertrand, the last word is yours.
Wow.
And congratulations on your op-ed, Bob.
I could say easy that everything has been said. No, I think you have to find the appropriate mix of ambition and realism. I think we have to be ambitious when we discuss infrastructure finance and the role of PPP, but we also have to be realistic. I mean, this is difficult, this is challenging, this requires a lot of investments in people, in money, in system, etc. So we cannot sell this as a silver bullet. And same with capital market. I mean, we participated in different meetings on this today. I think capital markets, keep it simple. Start with government, build your yield curve, build the ecosystem, have a real in-depth conversation between governments, regulators, investors, issuers. It's a 10-15 years plan. It's not a 2 years plan. It takes a lot of time. And so that's really my point. You can do this cooperation. Again, capital markets, PPP, it's not one person alone, it's people together. And just to finish with the commercial page, the good news is that the World Bank Group can help you on all these fronts.
Ladies and gentlemen, we didn't know that we would manage to do this in 40 minutes, and I think we've done it with 2 minutes to spare. I believe that the panelists have touched on all of the relevant and salient points. We didn't have a chance to go into them in great detail, but I think every single important point was raised. So please join me in thanking the panel for their contributions this afternoon.
Doing business in Africa. You can't afford to be without Africa Investor.